Evariste, thank you so much for coming.
Thanks a lot.
You cover the US market, European, and some emerging, right? And you're the person to ask this question. The US stocks, especially the futures, were rising. Now the stocks are rising after better than forecast data. Is this data really good? Are you satisfied?
I'm very satisfied. I think that this reflects exactly the way the economy is growing. You have some bad numbers due to the sequester, so the government is slashing jobs. But on the private side of the economy, everything's going very well. And you know, when businesses, services are going up, it's in general a very good leading indicator of forthcoming growth. So there is one black spot, maybe?
Yeah, I was going to ask if there is a black spot, if there's anything that we need to dig in behind
Basically,
this
where I'm a little bit disappointed about what I see on the manufacturing sector, because it's been the third month in a row with a decline in the numbers.
Manufacturing has been disappointing us. What is the reason?
Basically, I think that you still have some lackluster growth in the world. And the US have been benefiting from a weaker dollar, after a few years of decline, so was exporting out a little bit of the crisis. But now it's over, so we need maybe a little bit more of domestic demand. But basic domestic demand is here to stay. Look at the data, for instance, for households. They are gaining wages growing by 2% per year, and inflation is 1.4%. So you still have purchasing power in the US. So the momentum of the US economy is very good to me. You may have some slowdown in summer, but basically the data confirm that the strong momentum of the US economy is still here.
So you're satisfied with the non-farm payroll and also with the unemployment rate. Am I hearing this right?
Yes, basically the unemployment rate is broadly unchanged. And if you look...
What was your estimate? Sorry.
Basically unchanged as well. You know, a lot of the changes that we've seen in this unemployment ratio have been linked to the participation rate, whether people were going away or going back into the workforce. And when you have people going back to the workforce, it's a good signal. It's a signal that they're more confident in the future of the economy. So once again, a stable unemployment ratio at this stage is not that bad. It proves that people went back to find a job, which means that they're more confident. So once again, it adds to the good picture of the US economy.
How about the reaction of the stock market, the equity markets to this number? Because good news was bad, bad news was good, depending on Fed's reaction or the expected.
Yes, it's all about the Fed expectations. And basically, this kind of number provides the room for maneuver to the Fed. The Fed is clearly willing to try to do something in September, and now we know that they will do. So, but the thing is, they will do it the smooth way because they have, I would say, a boulevard in front of them. Low inflation number, strong or decent growth number, the Treasury is issuing less debt, so it's a good timing to try to test the market.
To taper down?
Exactly, to taper a little bit, to reduce the pace. By September, October, they will first start reducing the pace of purchases.
You're expecting it, really?
Yes, but basically, I think it's the best timing because the Fed, and especially Bernanke, told us, we will try. And if it doesn't work, we are still here. And it's not that much a tightening of monetary policy. It's just a reduction of the accommodation. I think it's really a subtle difference, but it is a difference because it's just providing slightly less support to the market, providing less liquidity at a time when the Treasury is issuing less debt. So the net impact on the demand for Treasury bond will not be that impacted. So I think that the stock market should be watching more the good numbers than making some speculation of a move by the Fed, which will be relatively tame to me. If you had a survey by Bloomberg this morning saying that economists were expecting the pace of purchase to go down from 85 billion per month to 65. This is nothing. When you have an economy that is growing like this, well, the economy can afford such a reduction in the monetary accommodation.
Even more, you're saying.
At the end of it, you will probably start 2014 with some stop or very low level of purchases. But once again, be careful. We have this tentative effort by the Fed to stop buying. But on the other way around, it does not mean that interest rate will be increased. With the level of unemployment that we have today, basically the Fed can still wait until 2015 to even...
For 6.5%? Yes. Because remember their targets, we're still not there.
Yeah.
Even the Chicago Fed head, Evans, said, I would like to see 200,000 a month
That's
in terms of increase.
That's a very interesting data. I've heard a lot of economists telling me that, you know, due to the fact that the participation rate is lower, now we can afford to have a lower level of job creation each month to reduce the unemployment. That's not true. It's true when the participation rate is going down. But basically, in the US, before the crisis, the population was growing at a pace of 2%. Now it's growing at a pace of 1 plus 1.1, 1.2. So you need less job per month to have a reduction in the unemployment when the population is growing less rapidly than before. So I would say...
That's the Bloomberg report too. Chicago Fed, yesterday, the economists at the Fed in Chicago, they say that they need only 80,000 jobs.
I think this is the low range of the estimates. But when you have data such as 130K or 140K like we had over the last few months, it's perfect. That's enough. And it's clearly in accordance. It reflects the new normal of the US economy, that is a growth rate, a potential growth rate, which is close to 2.5, 3% per year, not 4 as we had 1 or 2 decades ago. So I totally agree with those numbers because I think that the economy, a full-speed economy, will be creating jobs between 120, 150 per month, and that will be enough for the unemployment to fall.
But let's come back to the equity markets.
Yes.
They're sugar addicted. They love the Fed stimulus. How come we are seeing an increase in the market?
Once again, I want to talk about it. I'm very happy that you give me this opportunity because you will read everywhere that the equity market is going up if the economy is going down, or is going up if the economy is going up. It's not true. If you look at the movement of the S&P 500 over 3 months, they are very closely related to the ISM numbers, that is to the news flow. So there is still a huge dependency of the stock market on what's going on in the real economy. And that's why I think that if the stock market is reacting positively, it's not on the expectation of what the Fed is going to do, and because everybody knows that the Fed is going to be very careful. It's just because the economy is faring quite well, and stocks are not that expensive still.
Still not expensive.
No.
Thank you so much for
Thank
coming,
you very much
Evariste, and sharing your valuable insight.